Hello and welcome to the Private Capital Podcast. I'm Joe Riley, head of Circulus Group, a network for family offices based in Greenwich, Connecticut. Today's guest is Michael Fisch of American Securities. Michael Fisch is a founder and the CEO of American Securities, a $23 billion private equity firm that originated in the Rosenwald family office. This is a great story of a fabled family office turning their investment DNA into a thriving private equity firm by buying market-leading businesses. William Rosenwald, son of Julius Rosenwald, who built Sears Roebuck, started the family office back in the 1940s investing in private companies. Michael's mentor, Chuck Klien, took them to the next level in the 1980s and offered a role to 30-year-old Michael, who turned around and proposed building what became the American Securities private equity firm today. We talk about their first acquisition, why they seek out market leaders, the growth of the firm and overcoming bottlenecks, and their unique resource group that creates efficiencies and growth in their underlying companies. Before founding American Securities, Michael was a partner in 2 private equity funds, a consultant in the Paris office of Bain & Company, and a professional in the mergers and acquisitions department of Goldman Sachs under Jeff Boise. Michael received a BA in economics and policy studies from Dartmouth College and an MBA from Stanford University's Graduate School of Business, where he has been a guest lecturer since 2006. Michael serves as a director of the 1162 Foundation and a member of the Atlantic Council's Executive Committee. Please enjoy my conversation with Mike Fisch.
This podcast is for educational and entertainment purposes only. Anything said by the guests or host should not be construed as legal or investment advice. Thanks for listening.
Why don't you set the scene for us? Goldman Sachs, 55 Water Street, 1983. What was that like?
It was great. I actually never really got to work there. I interviewed there when I was a senior in college, and I was from Montreal, Canada, so I'm a small town fellow, or at least was then. And when I went to some of the other investment banks, they were in very new, tall buildings. And honestly, I got vertigo in some of the offices and waiting for people. And I was like, it was just a little scared. I've always been a little scared of heights. And it was like, wow, it's awfully high up here. I'm not sure I'd be comfortable. And then I went down to Goldman Sachs's offices, which you're absolutely right. They were 55 Water. And there were boxes piled high, and the windows weren't that big, and it was dark. And I really liked the people, and I felt super comfortable in the space. And they were kind enough to make me an offer. Actually, Jeff Boise, who was then running the merger department at the end of my interviews that day, extended me an offer. And I accepted it that night.
Jeff Boise, bit of a legend. Could you tell us a little bit about Jeff?
Wow, Jeff was just a great person to work for. Back in 1983, there were 33 people in the Goldman Sachs merger department. Jeff ran the group. But Jeff, I thought then, was really old. I think he was 32. He was married and had 2 kids and had a house in the suburb, and the Christmas party was at his house, and I went there, wow. He had speakers in the ceiling, and he was so old, he was 32. And Jeff was a super decent person, very self-effacing, and I know I was working all day and many nights, and I think Jeff was the hardest working person in the group. So he was led by example, very thoughtful, very good negotiator, but no screaming, no impoliteness, just an incredibly gracious man. I still see him once in a while, and it's just so great to just see him because I just think he's just a wonderful man.
What was the work like then? There was no private equity industry.
There was almost no private equity industry, you're right. The M&A business was exploding. Prior to the early 80s, Goldman had no merger department, and there were almost no mergers that were done because if you were a manager, came out of college, you might work in a plant on a line, become a line foreman, maybe run a shift, become a plant manager, maybe a multi-plant manager. And people would ask you at a cocktail party, how many people work for you? And the more was better. That was then the equivalent to what's your return on equity, what's your stock price, how are your margins, all these questions that people ask today. But then it was how many people work for you. That information age didn't really exist in the same way. There was a person who actually made partner at Goldman Sachs in the merger department, and near as folks could tell, what he really did all day was he'd go to the library, get the New York Stock Exchange books, and compile price volume charts so Goldman Sachs could tell a company what percentage of their shareholders were in at what price and whether the merger would be accretive or dilutive to the price they purchased the stock for. I mean, there was nothing. treasurers of companies really just didn't have information that now any assistant treasurer of any public company knows more about their debt trading or as much as anyone on Wall Street because of the information age. So it was completely different, but it was changing very rapidly. Other people may see it differently. Joe, you might have different memories, but in my mind, a bunch of things came together in the very early 80s. You had Jack Welch take over GE, which was then, if not the most respected, for sure, one of the most respected industrial companies in America. And Jack Welch articulated a plan that we're going to be number one in every business we're in, or number two with a plan to be number one, or we're going to sell it. And I saw this up close and personal because they were a client. And I had the pleasure to be in some meetings with Jack and Larry Bossidy and Dennis Damerman, their whole GE senior team. And so that one legitimized selling businesses for executives, which never existed before. Secondly, we had this advent of something that was then called green mail. It would be completely illegal today, but someone could buy a few $1 million worth of stock in a company, a big company, and threaten a proxy fight or a tender offer, and the company could buy that person out for sometimes 2 or 3 times their investment to go away. Now that would be completely illegal, but that happened then. So you had a bunch of people approaching companies saying you can restructure. This is before activist hedge funds. There were no really hedge funds then. There were some arbitrage firms, but not hedge funds. And no activist investors, certainly not many private equity firms who could be a so-called white knight. And so you had this green mail thing going on. And then that became animated by the advent of junk bonds and Mike Millikan, who was then in Philadelphia trading fallen angels, companies that had trouble or gone bankrupt, and saying, well, if I can trade them, they have value, so why can't I issue into that value? And that led to distressed debt. And so those things created the necessary conditions for companies to think selling was good, for public companies to have pressure to maybe restructure and realize someone could take them over, which historically didn't happen, and for that opportunity to be captured by green mailers in some extent, or white knights, private equity firms operating as white knights for hostile acquirers. And that created what has been really 40 years of growth in private equity, financial services, M&A, everything.
What role did lending play in that?
No one had enough money to take over anything, but when you had, let's say, a hostile raider be able to cobble together some money, and again, Saul Steinberg, T. Boone Pickens, Carl Icahn was doing this back then as well, and a bunch of others. If they could get financing, then a board had to respond to the possibility of a hostile tender offer and a takeover offer. And so the financing was critical to give them the potential capacity to mount a challenge, and then boards had to take it seriously. And in some ways, in a greater sense for the country, that forced many of our businesses, or caused many of our businesses, to restructure where they would have otherwise kept doing what they're doing, find efficiency, which didn't exist. And that made us as a country more efficient earlier than, say, Europe, where that came later. And even today, I would argue it's now coming to Japan now 40 years later, but it didn't exist culturally until recently.
Why did you personally find this industry so attractive?
Like so many things, I was lucky. When I was in college, I looked at the people who were peers in classes ahead of me and what they were doing. And most of them in the early 80s, or many of them that I identified with, were going into consulting or investment banking. And investment bankings were just creating these analyst programs. And I like numbers. I was pretty numer literate, I call it. And so I went into investment banking, and that was the dawning of those analyst programs then. I think Goldman Sachs in 1983, the analyst program was a total of 25 men and women. 4 were in the merger department where I was hired, and the others were in different parts of the firm. I think Goldman Sachs back then had approximately 1,500 professionals, 3,000 total employees. 4 years later, I think they had more than that in London alone. There's just an explosion that took off in every investment bank.
What happened to that analyst class?
Some of them are still very good friends of mine. Some of them are investors. I was best man in one's wedding, and he and mine. Great lifelong friends. I'm still close to a bunch of them, as I am some of the other people from those 33 people.
We were just talking about Lehman. Tell us a bit about Chuck Klien and how you met him and how he was introduced to William Rosenwald.
Chuck was just the most wonderful man, wonderful person, amazing human being that I couldn't imagine meeting someone so wonderful and being their partner. So William Rosenwald was the youngest son of Julius Rosenwald. Julius took over Sears Roebuck and Company around the turn of the century. That would be the 1800s and 1900s. from Mr. Sears and Mr. Roebuck. Mr. Roebuck being an inventor and Mr. Sears being a marketing person, as the office told the story. And Julius Rosenwald was a supplier. And so he took over the company, just like Ray Kroc, who didn't found McDonald's, but helped expand it. And Julius was a merchandising genius. And he really created the catalog, which allowed every person in America, whether they lived in a big city or a small town, whatever their race, religion, gender, to buy anything that anyone else could buy. And that was a very big concept. And also the downtown department stores. And so that made Sears a very successful company and thought very stable. Up until the 20s and 30s, almost the only companies that were allowed to be publicly traded were railroads and utilities. Very stable cash flow type businesses. And Sears was thought to be one of those, and so it went public in the 30s. Bill separated his money from the family and came to New York during World War II, and about July 1947 founded American Securities Corporation as a broker-dealer and the first corporate-owned broker-dealer. Since Bill came from some family wealth, he didn't want to lose that, and so it wasn't a general partnership where you have unlimited liability, as all the other broker-dealers were then. It was a corporation. And they, in addition to the stocks and bonds that would have been typical of a wealthy family, they embarked on basically investing in what today would call alternative assets. Private equity would be a part of that. And so they did some amazing deals in the 50s and 60s, which further propelled their ability to do more deals. The people who did those deals largely retired. They were led by a terrific gentleman who I had the pleasure to know named Hal Friedlander. And Hal hired Chuck in about 1978 to join the Rosenwald family. And Chuck he was a lawyer by educational training, but he had been an all-star research analyst. He had been a little bit of an arbitrageur. He had bought distressed debt. I met the other side of a trade. He bought a piece of debt from a German bank for distressed debt. Now it's a burgeoning business, but Chuck was doing that. Chuck was doing a bit of everything because Wall Street was so much smaller then. You could do that if you were creative. And he had a big following at Lehman Brothers and at Bear Stearns first, and then at Lehman, doing all these things and dabbling with partners. And he joined the Rosenwald family and became Hal's successor. I met Chuck at breakfast, organized by mutual friends, as Chuck was trying to rebuild the investment team. And Chuck was looking for someone to work with him. And his pitch to me was, Chuck then was 55. He said he wanted to retire when he was 60, and families take a while to get used to someone. So if I came and joined him then, he'd retire in 5 years, and I could potentially run the Rosenwald family money if things went well. And he said, what do you think about that at breakfast? And I said, I have a different idea, Chuck. I really like you. I don't know why, but I really like you. But my ambition is not to run the Rosenwald family money. You should keep doing that as long as you want. But I want you to become my partner and us to form a private equity firm in which the Rosenwalds can be the lead investor. And that would be super interesting to do with you.
How old were you?
That was in the end of 1992, early 1993, so I would have been 30. And Chuck, being ever the cautious investor, because Chuck was a brilliant investor, he said, maybe, come work with me for a year, and if things go well, we'll go do that. Maybe, possibly, perhaps. And I did, because I liked Chuck, and we started a terrific friendship for the rest of his life and too little of mine, because I miss him every day.
Tell us what the family office was like at that point when you came in the door.
It was super interesting, as all family offices are. It was on a floor and a half of the Channon Building. The Channon Building, for New York real estate buffs, will be known to be the building on the southwest corner of 42nd and Lex, right near Grand Central, subway underneath. And it had been in operation. As I said, the Roosevelt family was quite established. They had modeled themselves on the Rockefeller family. It was on a floor and a half, but they called themselves 2400 was the name of the family office. It was 2400. This is the 24th floor and for the floor below. And it had an office. Bill Rosenwald had 3 daughters. Bill still had an office there that was behind a hidden door because people at a certain point in his time had been worried about kidnappings and all sorts of other things. Each of his daughters had an office. One was active, very active in the business. And there were various other family office people, not so many investment people, but lots of accountants, lots of tax planning, lots of typical family office services. And so it was culturally very different than, for example, Goldman Sachs, for a smaller private equity firm, and I'd worked for 2 before I joined.
What was the tempo like there?
Measured, restrained. But again, in the way of family offices, extremely dignified, extremely polite, kind, trying to do the right thing, all the things, and thoughtful, all the things that I like to associate with family offices, but very few investment professionals. In fact, Chuck was a one-man band at the time, or he had one other person working on small investments, lovely man, and then I joined.
What was the rationale for starting American Securities? Why did you want to break off and do this very ambitious idea?
I had been super lucky to work for two private equity firms, and like any growth business right at the beginning, there's a lot of forces which have some people get into it, and some people really have fully developed super strong abilities and vision. And I would say, for example, George Roberts and Henry Kravis would be that for sure with Jerry Colbert. KKR has always been a very thoughtful, well-managed firm and still is today. Other firms, people came from different backgrounds, and so I did not find my way into a firm, and they were all tiny then. We're talking 5 professionals or less. KKR was less than 10. I did not find my way into a firm where I felt the right alignment with how I wanted to invest. And that's both some businesses and some concepts. And what Chuck and I agreed early on is we wanted to invest only in the market-leading business and number one market share company, some of the things that I learned from GE, because that company, in theory, has a fundamental advantage. It has the biggest raw material purchasing because it's number one, so it should have cost advantages. It has the biggest knowledge of customers, so it should have sales advantage. And if you don't give it away from scale and efficiencies, you should capture in consulting speak a greater share of that industry's profit pool. And that should be a safer investment. We wanted to buy that company only with the existing CEO who we wanted to keep backing. And if we didn't, we would just find another deal. And we wanted to put relatively low leverage on it because that would help ensure a successful equity return, even if not spectacular. Our view was hitting, and we wanted to buy that company in a GDP growth or better industry. And if we did those 4 things, we thought that was an appropriate place to invest high net worth capital and others who invested like high net worth players who were looking for consistent singles and doubles, not a home run hitter who would often strike out trying to swing for the fences.
Wouldn't firms like that already be well priced?
By definition, you're always playing the market. You're always paying the market clearing price. We believe then, and to some extent I still believe now, that our principles of investing would over-index to the type of people we wanted to invest with. So if a founder or CEO, and we've bought a lot of founder CEO companies, we're on the list of founder CEO friendly private equity firms deservedly, that woman or man should be a super discerning buyer of that private equity thing, not just the capital, because they should want not just the highest price to someone who's not involved in the business of leaving, but value someone who's always trying to treat their people the right way, wants to develop the business, wants to grow it, and has a bunch of skill sets and resources that can help them grow their business. We've always tried to position ourselves attractively to those people who want more than price, but we're fundamentally always paying a market clearing price too. The sum of that is we often get the last look at a company and have management teams and sellers want to prioritize our due diligence or have us included in their processes because we have a very high success rate of working with those companies well.
So the mid-90s, the market was going well, but I'm sure it must have been somewhat challenging to go talk to institutions. How did you gain their confidence?
So in a lending sense, the type of investing we wanted to do aligned very well with lenders who, again, when you're lending for prime, it was then prime plus something, they want to make sure they don't lose the money. They're not getting compensated for the great return. So the fact that we were putting modest amounts of leverage and buying market-leading businesses with the existing management, lenders were always super friendly and attracted to our investments. In terms of investors, we had the benefit in the first fund of the family office being our anchor investor, but we also attracted a college endowment, an insurance company, public company pension plan, and a bunch of wealthy individuals. And I think Chuck's investment acumen, and Chuck was well known and really among very smart investors in New York. Chuck was thought to be one of them, even though he had a very low profile and never sought the limelight. And some combination of his experience and perceived investment acumen, the families supporting us, and some relative youth movement in my involvement, enough people thought was attractive that we were able to raise our first fund. It was a mighty $71.4 million in 1984, and our first closing was a mighty 50 million. So it's not like people were beating down the doors, but it was enough to get us going when we started there.
Tell us about your first acquisition.
The first deal we did was a company called Katima. And Katima was a public company, which was really a diversified industrial company run by a terrific CEO named Hugh Williamson. And we took that company private, and every deal has its stories. So we announced that we're going to take it private, and it wasn't that big a company, but it had almost 10 different businesses, some of which we thought we could merge together, and some we could expand, and some we might divest. And a large public company, Danaher, approached us and said, George Sherman was the CEO of Danaher, great guy, wonderful man. Pat Allender was his CFO, brilliant CFO, terrific guy. And they literally called up one day and said, hey, we saw you're going to take over this company, Katima. You've got an offer to take it over. We like this company. We might like to buy it because we're interested in some of the businesses. And we said, we do have a merger agreement with the company, and we're always looking for investors. It takes a little more equity than our current fund, and we're not going anywhere. But if you wanted to co-invest in the transaction, I said, we would be happy to have you on one condition. They said, what's that? You both have to join the board and show up at board meetings, because we're always looking to learn. And Danaher then was on really a tear. And George is a very impressive manufacturing-focused CEO. He sadly passed away, but George was a very impressive CEO. And Pat was a brilliant CFO, tax planner. And I thought they could really help our investors do well. And so they ended up doing that. And they did show up at all the board meetings, and they were terrific partners. And they bought a filaments business, which was one of the divisions, and merged it into Danaher. And it was a terrific experience for all of us. And they became long-term friends and investors as well.
So I'm going to interview Paul Carbone from Pritzker Private Capital. And the question I'm going to ask him is, does he have any advice for family offices who want to start a private equity wing?
So again, the world was so much smaller then. I actually met Jay Pritzker in about 1992, 93, and thought about moving to Chicago. But Paul, I don't know Paul personally, but by reputation, he's a terrific guy, and I think they've done super well, and he would know better. I would say, in my case, the Rosenwald family was very evolved in their investment activity, and they've been doing it for a long time. So they had a positive disposition toward what we now call private equity, bootstraps when they started, and then LBOs, and now private equity. So they had a positive disposition, and that matters, because it's good if people want to do what you're doing. Secondly, they had been around parts of it, investing in companies. They were buying, selling stocks all the time. And by definition, you know far less when you're doing that. After months of due diligence, it's the type you get to do in private equity. So they knew about risking capital, and they knew about sitting on boards, and they knew about, from that, working with management teams in a constructive, supportive way, which is how we have always liked to engage. And if they lacked anything, they could have figured it out quickly, I'm sure. They didn't really have experience sourcing private equity transactions as much as other firms who were really private equity firms at that time, Joe, and financing those transactions. We looked at one company, and this might apply to them, but the joke was, tell us about your lending relations. We've got this much cash at our local bank. So that was their banking relationship. There was no lending. They were just a depository. And so I thought there would be a really good, likely partnership. In addition to loving Chuck and his experience, they had the same experience, and those two things that they didn't have much of, sourcing transactions and financing them. I had been doing that for roughly 6 years at two other private equity firms, so I thought I could cover that base, and we'd make a great partnership. One definition of a great partnership is, A, you're better together. You don't overlap in strengths as much as you cover extra bases, and your joint decision-making is better than your individual decision-making. And that was certainly my experience with Chuck and with the Rosenwald family.
Could you talk a little bit about the growth of the firm over the years? You started with $71 million. It was $3 billion in 2002. How did you get from there to here up to $25 billion as it is now? And what were the bottlenecks along the way?
The world being what it is, if people trust you with a little bit of capital and you do a good job with it, you are often entrusted with more capital if they still believe in your strategy. And so we have maintained a relatively consistent strategy, still trying to buy the market-leading company in its industry with the existing CEO and management team with reasonable leverage in a GDP growth or better business. We use different words to describe it, but literally And we have graphs for what used to be a written PPM way back when, 30 years ago, but it's the same strategy. We try to evolve the tactics all the time. The world gets more competitive. We got to get better all the time. But I think that our first fund was 71.4 million. Our second fund was 350 million. Our third fund was 650. Our fourth was $1 billion. Then we were 2.3, or 2.6, 3.6, 5, 7, and we grew with the industry and doing the same thing, but slightly larger deals, always staying below what I call Mr. Mega. Mr. Mega is anyone with, we say, more than $10 billion, and I would still say that, of equity fund size, because they don't want to write checks the size we're writing. We go back 30 years ago, there was a price break. This is our perception of the world, others may differ, but if you had the ability to issue bonds to buy a company, and the break point for a bond issuance then was 100 to 150 million. So if the company was big enough that you could issue 150 million of bonds, which meant you were probably buying a company 30 years ago for $250 million or a little bit more, the bonds, it just traded, the company tended to sell. You were talking about price. The company tended to sell for a higher price, Joe, and public companies tended to sell for a higher price as well. And so by looking a little below the biggest players, we believe that we were able to purchase companies and others like us for a slightly lower multiple, and that would make a safer deal. And so we like that. Again, investing with wealthy family investment principles. Don't lose the money, because if someone's already wealthy when they give you the money, the only way they become unwealthy is if you lose the money. So really don't lose the money is very much a part of our ethos as investors. As the private equity industry grew and fund sizes of funds went through, there was only one fund over $1 billion in the 80s, and then only one over 5. But as people grew to 10 and 15, we were able to, our niche being below the super biggest players of the firms. Today, you would think of it as the Blackstones, the Apollos, the KKRs, Carlyle, TPG, Clayton, Dublier, pick your names, they change a little bit. But below those firms, because of their scale, they're not happily investing 250 to 500 of equity. They need to invest 750 to 2 billion of equity per transaction. And as they grew, we were able to keep doing exactly what we were doing, but do slightly larger deals and have bigger funds, which allowed us to do those deals, which still kept us above a relatively large number of new funds that emerged because of the growth of private equity all the time.
You've had a very consistent strategy over the years. I'm interested in your screening process. What is it about these companies that you feel that you can get some efficiencies out of them?
Well, I'm not sure it's always efficiencies, and every company is different. One of the things about our strategy is we have a resources group. So we have the biggest part of our firm, over 50 people, is full-time functional operating executives in procurement, IT, financial planning and analysis, a whole bunch of stuff, Asia Pacific operations, that often one or another middle market company doesn't have the scale to be world-class in everything, almost by definition. And so in some companies, we have all these arrows in our quiver, if you will, that we can deploy in different companies depending on what the opportunity might be. And it could be strategic acquisition, it could be international expansion, it could be purchasing, it could be anything. And in some companies, meet a management team and say, hey, what about this? And they say, yeah, that's a great idea. We know it's there, but we just don't have the bandwidth to do it, or we haven't gotten to it yet, or whatever. And so we can bring operating expertise to like-minded folks and give them the scale to pursue things at a higher level of excellence than they can do on their own. And again, that's one thing back to the founder, or the perception of us as founder-friendly. Many founders really like this. They see us as being able to help them expand and build up their organization and take on new business challenges, new geographies, new products, whatever it may be, new plant operations. And we love partnering in that way. And so we like to think we try to bring more than capital to every investment that we're in and make 1 + 1 = 3 with the management team.
What was the origin of this resources group?
At some point, if you're lucky enough to attract capital to invest in companies, investors will say, what do you do with that company once you've invested in it? Why are you a good owner of that business? And in the early days of private equity, some would say, oh, we just make such great investments, we don't need to do anything. They can just do it. And there's maybe a very small number of people who may still say that. So you quickly start thinking, because people are asking you, why are you a good owner? What do you do to make the business better? The first answer never felt quite compelling to me, because even if you are that good, why give up even more upside by being a good owner? Many private equity firms have turned to a concept sometimes called operating partners or CEOs on the bench, where we just bring in a new CEO. And we always want to be value added to our partners, but never threatening. So that idea didn't work so well for us. And what we thought long and hard about is the resources group answered both questions in a way that was appropriate for our strategy and how we try to interact with our portfolio companies in the world. Having these functional experts who are super world-class that we can deploy to companies, and we don't charge for them. So it's free to our portfolio companies to help those portfolio company executives and CEOs succeed, hopefully is value added and is never threatening. So we kept building that group and thinking, what is it we can do on a group basis that no company would have on their own rationally? And so one easy example of that is ERP systems. So people running the IT system are usually super competent in all the companies we see, but a company only puts in a new ERP system every 7 to 12 years. So by definition, they almost have sometimes zero experience putting in a new ERP system. What consultants, what software, how do we pick it, how do we do it? If we have someone here at American Securities, we do 2 a year. They're world-class, and the result of that is we have a terrific record of putting in ERP systems on time, on budget, and getting success out of them with outside help. But we are basically the project management office who helps management run it and interact with these, get what they're hoping to get. That may not sound like a lot, but it's really risk reducing in the investment. Similarly, we have a purchasing group, and so we can help, you alluded to it before, we can help a lot of companies purchase supplies better and put in strong raw material input purchasing costs, which can save a lot of money. And our group is doing that everywhere all the time, so they're world class. And so there are things we can do that really help our portfolio companies succeed, and they are value added and they are not threatening, which is exactly how we try to be.
I'm sure there's a lot of pattern recognition involved in that. So you see these companies that might have changes in their purchasing or maybe in their operations, and you can apply that. Is that what attracts you to them?
Experience, it's always good to have experience. You have to be careful to make sure that it's not a false experience. We saw that baseball player hit a home run, so we think the next at bat looks just the same. She'll hit a home run too, and sometimes they might strike out. So you have to be careful with pattern recognition, but you're absolutely right. We have had consistent success at doing certain things well. And again, you mentioned 70 investments. There's many more add-on acquisitions that have been done as well. We've just looked at so many businesses with so many people and have seen what works well and we think is repeatable. And we've made our mistakes as well after 30 years. So not everything goes perfectly, and you learn from those too.
And you already have some of these add-ons in mind when you're looking at the space.
We try, and it's really one of the advents now. Almost every company that thinks about looking for outside capital hires an advisor. They have some form of intermediary, even if it's a friend like you or a big investment bank and anything. And one of the consistent things they would have heard from those advisors is, tell them about your ability to buy things. Tell them what's there to buy. It's one of those things you have to be careful and diligent, like how true is it? Because we know every CEO has been coached or been told by an advisor, tell them you can grow, tell them you can buy everything, tell them it's easy. It's such a great opportunity. Sometimes it really is, and you just have to figure that out. But again, we are professionals at buying and selling, so we have skills that can help them do that, where that's the interest of the management team and makes sense for the business.
So let's talk a little bit about CTB. What attracted you initially to CTB? Who were the owners?
Oh, there's so much there. So you've picked one from our first fund. It was the second or the third company we'd ever purchased. So CTB is a company that makes equipment for raising poultry and swine and also makes feed and grain storage bins. It is based in Milford, Indiana, and had some other plants, but that was primarily its location when we became involved. It was run by the grandson of the founder, a terrific guy named Chris Chicola. His mother was a very significant investor in the company, and his grandfather still owned a very significant piece of the company. And his grandfather had created the coreless auger, which allowed you to move feed and grain in non-straight lines efficiently. Basically turning, which on a conveyor belt, having that turn is hard, but with basically a corkscrew, you can navigate corners. And that was the big invention. And the grandfather wanted to do philanthropic things and had made some commitments. And so selling the business was what the family was thinking of doing, or bringing in an outside investor. And we were introduced to Chris and his COO, Roger Townsend, and his CFO, Don Steinhilper, in a conference room in Chicago at their banker PwC's offices. And if truth be told, I think we were the warm-up act. I think they had 6, quote-unquote, real buyers lined up, and they agreed to let us into the process when we heard this was happening through a friend and got a meeting. And you could imagine, as sophisticated as this management team was, they were selling things in Asia, they were selling things in South America, they'd been all over the world. They'd actually never been to New York, and this was in Chicago. And being in an accounting office room was maybe not that comfortable with them. But we talked about the business, we talked about our bona fides, and as a result of that, we were one of 2 people invited to visit the plant and show the business. And ultimately, they decided to let us invest in their business. And that's really what it was. They had the pick of, and they chose to let us invest. That was the beginning of a terrific partnership, and a lot of the things, some of which we still do today. We invested in the business. Right after we closed, we had a post-closing offsite with the management team. We still do that with every company. We call it a post-closing retreat. We go away with the management team and just get to know each other as people, because that makes everything move faster. We share all the due diligence, everything we learned, because we know that management is making decisions all the time. And the best thing we can do is make sure they know everything we know. And so we all have the same information, and then talk about what do we want to improve? How can we help now with our resources group, but in other things. We did that with Chris Chicola and his management team. One of the things that came out of that was some cost opportunities, so they would become more profitable. Rationalizing a small part of the business. They had gotten into the vinyl fence business for horse show jumping and docks. And that didn't seem to fit well with their business, and they agreed. They had done it for some family reasons.
How did you know that wasn't a good fit?
Well, it just was unrelated to the end market of poultry and pigs and chickens, and grain storage bins didn't have a lot to do with docks.
So you thought a lot about their place in the industry before.
Oh yeah, who are their end-use customers and the raw material inputs. And there was some overlap, but very little. And they just didn't have scale to compete. But they had done fencing for Olympic facilities, and they'd done some very high-end jobs, but it just didn't fit. So that was divested. They could focus on the core business. And then we went and bought a business with them in Belgium called Fancom, and we expanded also in the U.S. And then ultimately, about 18 months after closing, we actually took the company public. And so CTB became a publicly traded company.
What was the thinking behind that?
That there were really big acquisition opportunities, and having a public currency would promote their ability to keep growing and de-lever the company. Not that it was that heavily levered, but it just created excess capital.
We should probably say when this was.
I think we agreed to buy it in 95, 96, and it went public 18 months later. So we're talking a long time ago. You went back to, you're testing my memory. And then a couple years later, the CEO, Chris Chicola, actually wanted to run for Congress and serve his country. And so we went about looking for a new CEO, and we hired a terrific operating executive, Vic Mancinelli. He was really the best candidate. He was running a business in Wisconsin. And so I got on a plane and I flew to have lunch with Vic and say, Vic, we really think you would be a great guy to succeed Chris and run this business. And Chris is all for it, which he was.
What was so attractive about Vic?
He was in the agricultural space, and he was running a division of a well-thought-of company and doing it well. And it had a lot of applications to our business and our customers. And there weren't that many executives who had CEO experience running a business that was related to our business that we knew about. And Vic happily took the job, did a great job. And then at some point, Warren Buffett was calling, and we ended up selling the business to Berkshire Hathaway. And it's still a part of Berkshire Hathaway's portfolio, and it's done real well. And so it was a whole fascinating experience. And Vic was super happy because it was a great long-term home for the company, as was Chris and his family.
Were you ready for an exit at that point?
Yeah, we are portfolio investors. And while investors are always happy to get capital back, they're also happy for that capital to keep returning a good return. But management has their wealth concentrated. All of our managers are significantly invested in the businesses going in. All of them have option stakes to enhance their participation in the fruits of their labor. And so when there comes to points when executives realize that how much their wealth is concentrated in the business and it's illiquid, they have a higher desire to exit often than we do as portfolio investors. It was a super happy outcome for everybody.
What was it like doing the deal with Berkshire?
It's different. It's very different. I can't speak for the modern Berkshire Hathaway, but it's absolutely true. Warren Buffett, who I had first met when I was in graduate school in 1986, he is very thoughtful. He is very well read. And his son was involved in a similar grain business, and he'd followed that. So he knew a little bit about the business. And we were public. So he'd read our materials, and he said, okay, I think we like the business. I'm prepared to pay this price, and I need to meet the management team. I need to meet Vic and maybe the CFO for 60 or 90 minutes. Can they, and I can meet them, tell me when they can come to Omaha. And we might have said something like, okay, they'd love to come meet you. You're a big company. You're invested in all these aviation assets. Are you willing to transport them there? And he said, no, I'm sure they can find their way there, but I'm willing to meet them. So they went, and I desperately wanted to go because I thought that'd be so much fun. But I thought, and I'd learned so much, but that seemed inappropriate since we were the control shareholder in this public company. A banker went with them, and that banker wrote down the questions that Mr. Buffett, I say that with great respect, asked them. And that in and of itself, those questions are a tutorial on investing worthy of study. And ultimately, with a little bit of this and that, Buffett and Berkshire Hathaway did decide to buy the business and closed.
What were the questions?
They were very specific, but they covered the gamut from big picture macro to very micro questions to the classic Warren Buffett anecdotal question. Vic, would you keep working past 65? Because they advertise valuing seniority, longevity in their management team, and they do. But it was everything. It was commodity issues, competitor issues, it was international issues, it was operating. It was really a super broad, high and deep, thin and wide set of questions that really are thoughtful.
What are your questions like when you get down to the final screen? If you get down to the 10 companies you're really interested in, what are you going to ask?
Oh, for us, it doesn't quite work this way. They don't all come at once. Private equity is hard that way. Sometimes I'm jealous of public equity managers because they're all there in front of you, and you can construct a portfolio and know exactly what it is and enter at the right time and know the price, and it's easy. We see 400 to 600 potential investments a year. We'll meet the management teams of over 100 and really have many more management conversations than that. And each one each potential investment has its own timeline, and they come one at a time. And you can't think of these broad portfolio company constructions or relative questions of the same questions. But again, but you have to be informed by what you're trying to do and what's your filter. And so our filter starts with, are you a scaled player with a right to win, a market leading business, maybe not number one, but a scaled player with a right to win, like there's a reason why you should do well. Is your industry GDP growth or better? Ideally, tailwinds are great. But one observation, it's a blinding flash of the obvious from 30 years, it's really hard to make money in a company where its industry is going south. And likewise, it's really hard to lose money in a company where the industry is going north. Picking a good industry is really good. And again, you think about the risk. If you bought the market leading company and you buy an industry which is growing, and as long as you don't pay a silly high price, you should make money for your investors. And that's what we're trying to do reliably. And so we still do that. Most of our work is company and industry, and then reasonable price, reasonable financing. So it's a safe equity investment where you understand the cash flow and the variability.
How do you think about portfolio construction?
All of our companies are U.S. headquartered. Some of them are global, some of them are not, but they're all U.S. headquarters, so we can be active in the company as makes sense, and our people can be there and still have a reasonable personal life. But I'd say into your portfolio company construction, you try to find a good investment. They come one at a time. So once you find an investment in the industries you're looking at, then when the next one comes along, you want to make sure that, one, we never want a company that's competing with another one of our companies. And we think about what's the ultimate demand driver. Is it related to housing? So we wouldn't want to have a whole portfolio where it's all related to housing or related to autos or related to some commodity raw materials. So you think about what are the risks and trying not to double up risks so your investments are cross-correlated. And so portfolio construction is seeing deals that fit your box, and as you fill in more companies in each particular fund, making sure that you're not taking end market risk or customer risk or geographic risk or a macroeconomic factor risk, raw materials that could over-index so you don't have a strong portfolio in that fund.
So you have a strong record in retaining CEOs. What do you look for in a leader?
All the obvious, nothing special. Good person, good followership, successful track record, vision and ambition to grow her or his business, all the things. Motherhood and apple pie. You don't always find it, and none of us are perfect. I'm not perfect. And so if someone's got an imperfection, can we make them better? That's one form of a good partnership. Do you cover each other's skills, as I said with Chuck, and is there joint decision-making better than your individual? We look for the same thing in management teams, where we can be a good, helpful partner and have really positive interactions and relationships.
Is it a deal breaker if you don't like the CEO?
It is a deal breaker if we do not like the CEO, absolutely. Now, sometimes we may like the CEO fine, but we're brought in to help a CEO transition because someone's ready to retire.
Mm-hmm.
So sometimes we're brought in by a seller for stability or a CEO. But yes, we have never gone into a business where we didn't think we could have a positive relationship with the CEO. Sometimes it might be a risk factor, less than other times. And you always hope for times. You mentioned CTB. Chris Chicola is still a great friend of mine, an investor in all of our funds since then, and a personal friend.
Where do you think we are in the private equity cycle today?
Yes. So I say yes, Joe, not to be coy, but private equity has always been a cyclical business. One way to think about that cycle is when institutional investors, and I'm involved with some not-for-profits that want to invest in private equity and have, when they talk about going to private equity, what I make sure they understand is if you want to have $1, let's just imagine you got a $10 to invest, and you want to put 10% in private equity. So you want to have $1 invested in private equity. The nature of the fundraising business and you commit and then we draw down funds. So private equity managers like us, when we find an investment, we call to capital. So to have that $1 invested, you actually need to have $2 committed. But every 10 years, you got to know you're going to have to finance the $2 because the global financial crisis happens, because 9/11 happens or a recession happens. There's always something and it's different. COVID might happen. And so you have to be aware of that. And so now we are in a different kind of cycle in the sense that a lot of companies were purchased for relatively high multiples in the 2001 plus or minus timeframe. Not all of those companies performed as hoped. Sometimes people didn't buy them off GAAP. They bought them off pro forma projected, possibly, perhaps. And those performers didn't always work out. And they were purchased at a time when the base rates were effectively zero, or a LIBOR software, now we call it floor of 75 basis points. Now it's 450, 475. Even if the spreads are the same, let's say instead of paying 6% 3 years ago, senior debt is 10%, which is roughly that 4 percentage point is real money. And some companies have trouble covering cash flow and paying taxes and paying interest and paying the CapEx they need to keep growing the business. And even if they don't, some potential purchasers of those companies, because they're going to have to pay more interest, want to pay less. And that arbitrage means it's hard for a large number of companies owned by financial investors to get sold at a profit, which makes the general partner who controls it and the investors happy in the sale. And so they wait. And that has a backlog of companies generally in private equity that historically would have been sold that are still owned by the private equity firm now after 3 or 4 or 5 or 6 or 7 years.
What are your thoughts on continuation and evergreen funds?
They're complicated and they have some conflicts. I think the industry and investors have largely figured out ways a lot of the time, and many investors who are in the primary funds are also investing in continuation and secondary vehicles, and so they're playing all sorts of the ecosystem. And as the industry grows, there's more and more, like the stock market used to just be stocks, and you buy the stocks, and then there were S&P 500 index, and then there's sub-indexes, and then there's options, and then you layer in different ways to manage risk or to take risk. And I think that's happening in private equity in interesting and sometimes complicated ways, but it defies a one-word answer. A public company is, in a sense, an evergreen company.
Mm-hmm.
You can always buy it and sell it. So if you have a private equity fund, which isn't public, you can't buy it and sell it. There's the secondary market, which is relatively illiquid. And as people move to an evergreen fund, if you think about it that way, and it's publicly listed, now you're a publicly traded investment company and someone can buy and sell. So there are going to be, and there have been lots of evolutions. I think there'll continue to be evolutions that fit investors, buyers, sellers, intermediaries, criteria and needs at a particular moment. And it's no one size fits all. But I think the ability of people to interact with private equity is only going to grow private equity. At some fundamental high level, institutional investors around the globe have on average 10 or 12% of their portfolio in alternative assets, private equity. And the retail investor has on average zero. And that's a bigger pool of capital than the institutional investors and will be more important to retail investors. And so some of these evergreen vehicles, I think they're going to keep growing. SPACs are one version of an evergreen vehicle, even though it's a publicly listed acquisition vehicle. So there's a lot of things going on in lots of different places.
I'm curious because obviously we talk a lot about alternatives going mainstream and going retail. And what do you think the market will look like when that huge wall of money actually comes in? Let's say the retail investor does allocate 5, 10, even 15%.
I think it leads to private equity growing. There are some academics who write about private equity being a better place, a better way to hold corporate assets than being public, because a board of directors, which is very heavily invested in the business, which isn't the case for every public company, and a management team that has significant, not only investment, but upside through the option programs that are typical of private equity. So these academics have said that private equity might be a more efficient form of holding corporate assets. And if more money flows into this, the private equity company ecosystem will grow, I suspect.
Michael Fisch, thank you for joining us and sharing
Pleasure.
your wonderful insights.
It's a pleasure, Joe. Thanks for taking the time.
Thanks for listening. If you enjoyed the podcast, please leave us a review on Apple Podcasts or share it with your friends. Thank you.